Ladies and gentlemen, good day and welcome to the Star Health and Allied Insurance Company Limited Q4 and FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Snyder Albuquerque from Adfactors PR. Thank you, and over to you, sir.
Thanks, Faizan. Good evening, ladies and gentlemen. From the senior management, we have with us Dr. S. Prakash, Managing Director, Mr. Anand Roy, Managing Director, Mr. Nilesh Kambli, Chief Financial Officer, and Mr. Vinod Rajmani, Head of Investor Relations. Before we begin the conference call, I would like to mention that some of the statements made during the course of today's call may be forward-looking in nature, including those related to the future financials and operating performances, benefits and synergies of the company's strategies, future opportunities, and growth of the market of the company's services. Further, I would also like to mention that some of the statements made may involve risks and uncertainties. Thank you, and over to you, Mr. Anand Roy.
Thank you, and good evening to all of you. I thank you for joining the earnings conference call of Star Health and Allied Insurance Company Limited for Q4 22 and FY 2022. I hope you and your colleagues and family members are all safe and healthy. I will give you a brief overview of the industry trends and developments that we have witnessed in the last few months, as well as walk you through the company's performance in terms of premium and distribution. My colleague Dr. Prakash will cover aspects related to claims, including the steps that are underway to manage them. Overall, the general insurance industry has reached gross premium of rupees 2.2 lakh crores and registered a growth of 11% for FY22. As regards to the health insurance industry, there was 26.2% growth in health and personal accident business in FY22 over the financial year 21, driven by 31% growth in group health business and 39% growth in the government health insurance business. Retail health continued to grow impressively at 16.5% in FY22 over the same period last year. With respect to Star Health, our GWP grew by 22.1% in FY22 over FY21 to rupees 11,463 crores, with the retail health segment growing by 22.4% in FY22 over FY21, compared to the industry's retail health growth of 16.5% in the same period. In FY22, Star Health has registered 33% market share in retail health, which is 3 times the second largest player in the industry. As far as attrition share is concerned, Star Health has registered 42% market share. Agency business continues to contribute around 80% of the overall business. Our agency strength has increased to 549,000 agents with an addition of 87,000 agents over last year. Corporate agents, banks, and other tie-ups have also picked up momentum, and the premium has grown by 63% in this segment. We had a number of positives in FY22, including premium and distribution front. We launched several new products during the quarter, including Star Women's Care Policy and Star Health Premier Policy. Star Women's Care Policy obviously covers women and their family, has many unique benefits. Star Health Premier is a offering for individuals above the age of 50 years. We have seen encouraging results for both the products. As discussed during our last quarter earnings calls, we have exited some of the large group health insurance policies during the quarter, as evidenced by the 28% reduction in group health premium during quarter 4 FY22. This move should help improve profitability for us going forward. Group health segment can be split into employer-employee groups, such as large corporates and SME segment, and non-employer-employee groups, such as group master policies for bank account holders. We remain very positive on the SME and non-employer-employee groups. Non-employer-employee group policies are largely sold to retail customers of the banks, and if we include these policies, our overall retail growth is 23%. Our recent initiative to grow rural business has been impressive. It is proposed to be largely digital, resulting in a cost optimization model. Currently, there are 200 branches and close to 800 one-man offices that are covered under this vertical. Health benefit plans, including group such as critical illness and hospice, grew by 39%. We intensified our digital initiatives during the pandemic. Some of the outcomes of the digital initiatives were: our app downloads have reached 1.46 million downloads. Digital policy issuance has been 60% in FY22 versus 56% in FY21. Digital sourcing, defined as premium collected directly from our website, as well as third-party web aggregators and online brokers, has grown by 34% year-on-year and now accounts for 6% of the overall GWP for FY22. We have launched our WhatsApp services in January 22 in partnership with an InsurTech partner. We now have a conversational AI tool that can transform customer engagement for us on WhatsApp. We also launched sales renewals through WhatsApp. The initial results are very encouraging, and we will talk about it soon. We have developed an in-house machine learning model to predict whether a customer will renew his or her policy before the due date, and with what probability score. The results have been very positive. This model has improved our renewal retention before the due date by approximately 3.5% and prevented revenue leakage. Quick quote engine. The policy quotations can be generated easily by our agents in seconds on a user-friendly platform with minimal efforts. Ever since this rollout, over 30,000 quotes were generated daily by our agents. Benchmarking shows that our agent efficiency has improved over 40%, and it leads to further higher agent adoption. Our CRM includes lead direct integration provided for websites, customer portals, WhatsApp, and our Twinkle chatbot channels, along with user interface-based lead allocation logic enabled in the CRM. Language barriers in lead assignment is addressed, and also Facebook ad leads and digital dialers are enabled in the CRM. All this resulted in a 300% increase in our lead and campaign management results. Now I would like to hand over to my colleague Dr. S. Prakash for claims-related comments.
Thanks, Anand. With regard to claims in Star Health Insurance, for the Q4 of FY22, the claims ratio for Q4 of FY22 was 68.1% versus our Q3 results of 104.6. Q4 2022 claims ratio has almost normalized to pre-COVID levels, excluding the COVID Omicron impact. We see the trend continuing in April 22. The provisional claims ratio for April is around 67.6. The combined ratio for Q4 FY22 was 98.4% versus 135.7% in Q3 FY22. So for FY22, combined ratio is, for the whole year, the combined ratio is 118% versus 122% for the previous year, FY21. The claims ratio for FY22 is 87.1%. Claims ratio for financial year 22 would have been 65.8% without the impact of pandemic. During Q4 FY22, there was some impact of the Omicron wave, with the COVID claims incurred during the quarter amounting to INR 1.2 billion. Excluding this COVID, Q4 2022 claims ratio is 63.9% only. I just want to brief some of the initiatives on claims. The share of hospitals with the pricing arrangement, what we call as agreed network hospitals, the cashless claims from these hospitals as a proportion of overall cashless claims has increased from 55% for last year to 64%. Cashless turnaround time, that is those claims addressed within 2 hours from the time of receipt of claims documents, has improved to close to 90% from what it was around 57% last year. For COVID claims, that within 1 hour is close to 99%. We have initiated the process of identifying hospitals called valuable service providers. Currently, we have 1,200 plus hospitals. This is to help our valued customers to have hassle-free medical attention and quick processing of claims. Over time, we expect to have better control on claims traffic to valuable service providers by negotiating better prices and offering a superior experience to our customers. We stepped up our telecommunication, what we call as Talk to Star, to close to 7 lakh consultations till date and wellness programs. Talk to Star, our teleconsultation, has helped in cutting down claims costs by giving customers access to experienced doctors for second opinion and alternate medical solutions. So in general, in terms of profitability, Q4 of FY22 would have been a break-even quarter, excluding the impacts of COVID and non-business ESOP costs. The COVID claims incurred during the quarter amounted to INR 1.2 billion and non-business ESOP cost was INR 0.55 billion. Our investment assets have grown to INR 114 billion in FY22, vis-à-vis INR 68 billion in FY21. Investment leverage, which is investment book to net worth, has reached 2.4 times as on 31st March 22. We have further strengthened our gross IBNR by 61 crores during the quarter, taking the gross IBNR reserves to rupees 397 crores. Solvency as on 31st March 2022 is 1.67 times. This was expected considering quarter 4 2022 is the biggest quarter in terms of premium and the cost of acquisition is accounted upfront. As we speak, the provisional April 22 solvency is around 1.77 times and is estimated to improve going forward. We have introduced 7 new products and added features to 7 products during this year. Our digital initiatives on the sourcing and service side have given good results and we are progressing in the right direction. To conclude, ladies and gentlemen, our focus on the attractive retail health segment continued during this quarter. We believe that the worst of COVID impact is behind us and things should only get more predictable going forward. We continue to believe that we are well placed to take the advantage of industry's growth opportunities going ahead. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, thank you for the opportunity and good afternoon, sirs. My first question is on the retail health side, on the growth. Wanted to know your thoughts on how you think FY23 should pan up, given that you are now 33% of the market and have quite a sizable base. Going forward, how do you think your growth could be on the on the current base?
Yeah, thanks for the question. Star Health, we are very focused mostly on the retail health segment, and we believe that we are confident of growing much faster than the industry's growth rate as far as retail is concerned. We have been able to showcase close to mid-20s growth rates in the past, and we believe that we'll be able to sustain that growth rate in FY23 also.
Yeah. So, sir, the reason why I asked was that because in Q4 there was slight tapering from that mid-20s level. So whether there was, this was largely aberration because of the COVID wave at the start of the period that impacted the distribution, or anything else to read into that?
Yeah, you're right. So Q4 of last financial year, that is 2021, had a major COVID upsurge, especially in the month of March, and thereby the base was on the higher side. So there was a little bit of tapering on the growth rates in the current Q4. But having said that, we have been able to improve our market share during the year, and also our accretion rates are more than 42% of the industry. So I think we will be able to maintain that guidance which we are giving you.
Okay. And in terms of the loss ratio going ahead, so if we consider that some amount of COVID claims will continue to be there, how much can we think in terms of generally you are in that 63 to 65% what you have guided in terms of loss ratio? Does that include a steady state COVID claim that might come through, or should we expect something like what you mentioned for April, around 67.5% or so for loss ratio? Hello.
Mr. Mukherjee, does that answer your question?
Am I audible?
Yes, you're audible.
See, April, we do not have the exact figure. It's only a provisional figure. It should be somewhere between 64, 65. Because, we have only yesterday the month has come to an end, So we don't have the exact figures for April. It should be somewhere around 64, 65. So, and with regard to your question on the COVID-19, the impact of pandemic, we are seeing a progressive decline from January to March. And April also is very favorable. The number of COVID claims are sizably less during April. And the impact of pandemic, as we could see for the whole quarter, by number of claims it was around 4.7%, and by amount it was around 6.3%. For the month of April, we have yet to study the numbers exactly.
Yes, sir. What I wanted to mean was that there would be, of course, I think if COVID is a continuous phenomena here on, like we'll have to live with it. So then some amount of COVID claims should also continue to come to all health insurers every quarter or financial year. So your guidance of loss ratio, does that bake that in, or should we expect a little bit additional over and above what you guide in terms of the loss ratio? That is what I wanted.
Yeah, based on the experience, some part of COVID is built in. As we spoke also that we have improved the IBNR also by 61 crores. So some part of COVID is definitely built into the loss ratio that we have been projecting.
Okay. And also on the specialized product, given that you have grown at a very strong rate, will that be? How are the profitability of those products, and would there be any discernible impact on loss ratios because they now are around 15% of the mix?
See, so specialized products are now contributing close to 15% of our overall retail health GWP, and specialized products are doing relatively well. When we exclude the impact of pandemic, we continue to see them favorable.
Okay, so would that mean that they would be, loss ratio would be better than your blended loss ratio?
So certainly the loss ratios are expected to be much less for our traditional specialty products like cardiac care and cancer care and diabetes policies. But very recently, we have introduced exclusive policy for women care, taking into consideration all the women-related healthcare needs. And this product we recently launched maybe close to 5-6 weeks now, and this product is very well accepted in the market. We are seeing a very good response, and this product is also reasonably priced high compared to our routine Family Health, Optima, and other Mediclassic individual products.
Okay, that's helpful, sir. Couple of data if you could share. You had disclosed in the DRHP the loss ratio in SME and non-SME for the group business. If you could share where it stands at end of FY22 or for Q4 FY22, and also what is the percentage of non-employer employee business in your group business?
Current year SME number is including the COVID, so that's the reason we've not disclosed it, but we can share it offline, the split of COVID and non-COVID. In terms of non-employee with our new partnerships, it has started to pick up very well. We saw very good exit for Feb and March, and that's a growth area for us in the coming year.
Thank you, Mr. Mukherjee. May we request that you return to the question queue for follow-up questions. The next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. Good afternoon. Couple of questions and rather clarification. The firstly on solvency. Can you clarify if my understanding is correct? Basically, the deferred tax asset creation is also hurting your solvency. I mean that going forward, if you return to profitability and say, if your PAT is going to be 600 and PBT is 800, broadly it's the 800 crore that will accrue to the available solvency capital. So basically, my question is that is my understanding correct that over the last year, your available solvency capital has been more hurt by like a PBT number, not a PAT number, because it's lost. And also going forward, because your solvency gradually requirement will move from claims to premium, so that's why also the required solvency number will go down. So that's question number one. Second, in terms of growth, basically let's break it down. So if I say that broadly, if retail health is going to say grow at around 20%, but given that the large incumbent public sector is typically growing at slower rate, and that means that
sorry to interrupt you. There is a disturbance from your line, sir. We are not able to hear you clearly.
Yeah. So I'm telling that on the growth side, that's my second question. If the overall retail health growth is around 20%, and say public sector is going slow, that means the multi-line and private put together are going to grow at 24-25%. Is a target, a strategy or target to grow in line with the multi-line and size, and thus they have the capital that is sort of going to support that growth? So two questions. First on the solvency, my clarification, and second on the growth target. Thank you.
Yeah. Avinash, to answer on the solvency, yes, it's correct that once we start, towards profitability, we'll get the benefit of deferred tax which currently gets created in the year of loss. The second is, as we have spoken, that with the lower claims ratio, we start moving to RSM 1, and the requirement of RSM 2 keeps on reducing. The gap between RSM 2 and RSM 1 keeps on reducing. That's beneficial, and with profitability along with deferred tax, the actual PBT also gets added to the net worth. So all these three factors will contribute to the improvement in solvency. And that is what we had commented, that April, where we have seen around 64-65% loss ratio, the solvency has jumped up by almost 10 basis points, 10 points from 1.67 to 1.77 provisional in the month of April. And we believe it will continue to move forward, as in the coming months.
Yes, and my second question on growth, then again I can sort of have some follow-up on this solvency, please. Second question on growth. Are you targeting your growth to be in line with the SAHIs and multi-line, where I see sort of, okay, if the overall sector is going to grow at 20, because the public sector is growing slow, SAHIs plus multi-line should be growing somewhere around 25%. So what's your growth target?
Yeah, see, Avinash, we are looking at ensuring, as you rightly said, a growth higher than the industry itself. Now, industry, if you're removing the public sector and only counting the SAHIs and multi-line, we believe that we will be able to grow at that pace or even slightly higher than that. But our focus is right now not only on growth but also on quality of growth. That is something that we want to, definitely, make a change. So we have now decided that our underwriting in certain areas are getting more stringent, and we are also looking at exiting certain loss-making areas which I've already spoken about, especially on the large corporate side. So that will definitely have some impact on the growth, but we are confident that we will be able to grow faster than the industry.
Okay, thank you. Just a quick follow-up. Because you on the solvency side, of course, I understand, but you are clarifying that going forward, you're going to get relief from two sides. I mean, of course, on the available solvency capital side, it's the PBT that should be aiding, not just that. So that's what, okay, the solvency glide path to available solvency capital should be sort of a sharper. And the second part is that on the required solvency side, you are saying that, I mean, eventually you are, because particularly in the next quarter, when the delta quarter moves out in the last 12 months, your solvency required capital should gradually move more towards the premium factor than the claims. That put together, I think this 167% solvency should not be a cause of worry for us. Is my understanding correct?
Absolutely. That is where, we spoke about April solvency, which has improved, and we believe, in the next 3-4 months, it should be well above 1.9 levels in the next 3 to 4 months.
Okay. Thank you, Mr. Thank you.
Thank you. The next question is from the line of Ajox Frederick from Unifi Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. I just have one clarification on unexpired risk reserves. So how do we see that number going forward? I'm assuming there are two levers, right? One is unearned revenue, the other is the increase in risk reserve itself. So what is driving this increase, particularly Q4?
Yeah. So, that's what we have been mentioning. Why Q4, the combined ratio is good, but still it's a break-even quarter. So what happens in Q4 is last quarter, roughly 35 to 36% of our business happens in Q4. With 1 by 365 logic of URR, large part of it sits in the reserve. The policy is booked on 31st March, though it is part of the net return premium. Everything is URR because, it's only 1 day that has expired. The balance is 364 days earnings will come in the next following year. So that's the reason Q4 will always have a higher URR addition to the unexpired risk reserve. Having said that, one has to look at the balance sheet, method of URR. So for the full year basis, net return premium to the outstanding URR is around 56%, and one has to look at the quarterly net return premium and what's the P&L impact of it on the URR. It's slightly technical. We can take it offline also. But
yeah, sure.
Quarter 4, it will always be a higher URR number for SAHI.
Done. So if we normalize it over years, I think it will balance out. Okay, I understood that. So number 2 is on the non-operating expenses, particularly the ESOP cost. So what is the runway there?
So these ESOPs were granted on 1st December 2020. It's a 12 months vesting period. The first 4 months cost has come in the current year from 1st December to 31st March, around 74 crores. The balance cost from for the period 1st April to 30th November will come in 22-23, which is around 150 crores. That's a non-business expenditure. It does not have an impact on the solvency as well.
So this 150 crores is for this year, right? 23, FY23.
Yeah, 22-23, yeah, balance 150 crores will be gone.
All right, sir. That's it from me, sir. Thank you and all the best.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So firstly, looking at the growth, when you're saying you'll be able to grow upwards of 20%, could you throw some light as to what would be the drivers in terms of number of policies, premium increase, sum assured increase? What would be the key drivers for this?
So, the focus will be on the retail side. As far as the distribution mix is concerned, Star Health is very strong in the agency business, so agency will continue to be the main key growth driver. And our other alternate channels like bank assurance, digital, as well as we have started a new vertical for semi-urban and rural markets. These will also play a major role in our growth for the current financial year as well as for the future. But as far as business mix is concerned, last financial year we have been able to showcase almost more than 23% improvement in the sum insured of the policies that we are selling as far as new policies are concerned. I think that will remain a focus area where we would like to sell higher sum insured policies, and that will be something that we are incentivizing our sales team to focus on that. As far as we are also looking at some data points here where the contribution of higher sum insured policies, that is 5 lakhs and above sum insured, has gone up from 50% in FY20 to 64% in FY22. I think that will be the trajectory that we would like to maintain to grow our retail business. Distribution, as I told you, will be heavily focused on retail side.
Yeah, sir, and what are your thoughts on price? So I think we took a 15% hike in our flagship product in the previous year. What are your thoughts on price hikes in both retail health as well as group health?
See, as far as retail health is concerned, as you rightly said, we have taken a price hike in one of our leading products, in the Family Health Optima. We are also looking at revision in prices in some of our other products as we speak. We are evaluating a couple of them, and probably, if the case allows, we will be filing that with the regulator for a price revision. But price revision is the last option for Star Health Insurance. We do not take that as the first option. We try to have some internal, as I told you, to promote profitability of those products by pushing for higher sum insured and by reducing incentives and wherever possible, commissions and so on and so forth. But yes, we are looking at a couple of products on price revision. As far as group policies are concerned, we have already decided to be very conservative and we have decided to be quite conservative as far as large corporate business is concerned, because this segment unfortunately is a loss leader as far as health insurance business is concerned. So we are very conservative there. But we are very positive about the SME segment and the other bank assurance type of groups which we are focusing on. So I hope that answers your question.
Yeah, it does definitely. Sir, another thing was the URR question. So on a full year basis, would it be fair to assume a URR growing industry with a growth assumption of 20% plus and 35% of the business coming in the fourth quarter? Is it fair to assume a 15 to 16% kind of URR for the full year?
See, URR you have to again consider as a balance sheet number. So if you take the Schedule 14 number, the outstanding URR, divided by the net return premium, it is up to around 56%.
Okay.
That's the trend which will continue in future. And then you can calculate, because it's a function of growth itself. URR is not a standalone number, it's a function of growth. And one has to look at quarterly numbers for the outstanding URR and how it gets released to the PNL.
Okay. And so lastly on the claims bit again, how how are you seeing the severity in the non-COVID claims? Have they been rising substantially, or say, pre-COVID versus currently? What is the additional severity of those claims, and whether we expect the severity to go down, or one more point to that would be whether any COVID-related amounts are being built in those claims right now. That would be my last question.
So the severity for non-COVID claims, we could see over a period of last 4 months, there is a progressive decline. Because, I think, people have got most of their medical issues addressed during the third quarter of last year. And we are not seeing any fresh trend or, new onset of epidemics or fevers during these January, February, March, and even April also. So I have a feel that there are no major surgical procedures waiting to be addressed as we saw during Q2, Q3. Like, here most of the pendencies are addressed. There are no fresh bouts of any infectious diseases. And non-COVID claims, we don't see any surge in the last 3-4 months.
So my question was more particularly if I compare like to like between, say, claim on a particular surgery currently versus pre-COVID. How has been the severity, and whether any specific COVID-related, like the COVID test or the PPE kits, or all those are still being recovered out of those, or how is the trend? Has that changed?
Overall, on the non-COVID trend, severity, there is definitely some decline compared to the peak of the pandemic and the Q3, Q4, whatever we face. So progressively, month on month, we could see some decrease in the severity for non-COVID claims. Although hospitals are in the mindset of charging for some of the protective equipment and COVID-related tests and sterilization measures, but we are able to have a better control with the hospitals, and we could see month on month a progressive, gentle decline in the average we pay per claim.
Okay, thank you so much.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Sir, if you see the contribution of new business as a percentage of the total premium, retail premium, what we have collected, it seems to have come off to 23%, and if you see in absolute numbers, it has declined by 5% probably if I do a back calculation in FY22. So just wondering, if new business growth remains a little muted compared to overall total premium growth in retail health and largely driven by renewals, then should we expect that loss ratios to be on the little higher side compared to what we have reported before? Or you are confident that the higher contribution of specialized product contributing to the entire premiums, which invariably has a better loss ratios, can compensate for any deterioration happening because of mix changing between new and renewal? So that's the first question I have. And the second question is again, though the solvency, as you have said, has improved to 177 in the April month on provisional basis, are we revisiting our reinsurance strategy or to make it more capital efficient, or given you get the kind of commissions from the reinsurer, any thought process on those directions or any incremental update on that direction will be useful.
Sure. So to address your question on the new business, see the new business current year's performance is coming off a very, very large base of very high growth of last financial year. FY 2021, where the company was able to grow new business by 70% plus. So I think it is purely a base effect, and many of these COVID-related policies did not get renewed, which were taken in the last financial year. So it had its impact on the current year's new business growth. But we are very focused on new business and contribution of the new business. So we expect that this financial year we will be able to substantially grow the new business also and the renewal business portfolio as well. So the accretion will be the right parameter to see how the company is performing, the retail premium accretion, where the company has almost 42% market share, and we have been able to maintain somewhere close to that and grow that also. So I think that would be sufficient to say as far as the business growth plans are concerned. I will request Nilesh to talk about the other second question.
Anand, just on the loss ratio, if you can expand a bit, because of the mix. If you come, basically you are trying to say that the mix will go back to maybe 27% or 25 plus kind of a percentage contribution of new to the total. Then you are confident that 64-65 kind of a loss ratio is still achievable. To just extend this argument.
Yeah, absolutely. The new business contribution will be upwards of 25% is what we are expecting. And as a result of that, our loss ratios traditionally has been hovering around, between 64-65%. We should be able to maintain that going forward.
Got it. On the reinsurance side.
Yeah. So just to add one more point, this FHO price increase that we have taken in August 21.
Yeah.
Got effective from August 21. Jan to March 22 is our biggest quarter, where these policies have got renewed. And the benefit of this renewal will flow in the current year. The actual benefit or the biggest part of the benefit of FHO price increase will flow in the current year. On the reinsurance part, we have been evaluating reinsurance, but as we see that the things are improving, we have kept it as a backup plan. Second is, as we spoke last time as well, in case if there is some urgency or some COVID wave that comes in, subdebt is an option available which will give us an immediate solvency booster. We have around 800 crores of subdebt eligibility based on 31st March numbers, which is available to improve our solvency. So
Got it.
But subdebt is definitely available.
Got it. Yeah, and last one. Out of the total claims what we settled, how much are cashless in nature? We have said that a large part of are happening at a preferred network, but it is as a percentage of cashless claims. So out of the total claims, what we settle in a year or in 22, what percentage is reimbursement or non-cashless in nature?
So the cashless is, there is a progressively increasing response to cashless. Post the pandemic, the Omicron wave, you could see, hospitals opting more for cashless, and by number of claims, it is around 64% cashless.
Okay.
Financial outgo, it should be more than 72-73%.
Got it, sir. Got it. Perfect, sir. Thank you very much. That's it from my side.
Thanks, sir.
Thank you. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Hi, thank you for the opportunity. Sir, I have two questions. Firstly, on the gross premium growth. So while if I see the growth that Star has reported in FY19, 20, 21 is of around 35%, 27% and 36% on gross premium levels. So while you've spoken about the levers you have, do you think these 30 plus percentage growth levels that not just Star but even the SAHI players or the industry was seeing, do you think that is something that can get repeated in the coming years of 23, 24, or do you think that the advantage that COVID or gave you in the past years has sort of gotten built in over there? Secondly, on the hospital network, we can see that you've added around 2,000 hospitals in FY22. And so just if you can give a little bit of flavor around these, are these hospitals more tier 2, tier 3 city focused? Do you get better rates in these hospitals than the rates that you get from large hospital networks? And do you have any targets? Like I remember seeing a newspaper article where you spoke about you'll be adding 1 lakh agents every year. So do you have any target on how many hospitals you'll be adding to your network? So these are my two questions.
we are seeing a lot of interest from the hospitals to be our network providers, and we do around 200 hospitals in a month for empanelment. So it is not the matter of just increasing the number of network hospitals. It is the quality of the transaction and the number of claims. So we want hospitals who are scoring well in our assessment and who are valuable service providers to participate more rather than having more and more number of hospitals. The hospitals, we are increasing to have a pan-India presence so that a customer from the rural or tier 2 city also should have an access to our network hospitals. But the quality of business will depend only, we'll have to empanel them this year and see how many of them. Some of them are curious to be empaneled, some of them are effectively working after empanelment, and they are having a good insurance business in their turnover. So these things we will know only after a year, but in the last financial year, 90% of the empanelment that we had, whether it is a bigger hospital or a smaller hospital, we are only doing it with the pricing arrangements. Before we used to accept hospitals based on the empanelment request if they submit all the necessary documents. But now we are making it a mandate that 90% of them get empaneled with us only if they accept to our pricing arrangement. So these newer empaneled hospitals, when they start working actively with us, with the pricing arrangement we have, we should be able to better address the severity.
To answer your first question on growth, as Mr. Anand Roy sir said that, 22% growth was recorded for FY22 on such a large base. Accretion is the right number, for a company of our size. More important, we have been able to increase the market share from 31% to 33%. And going ahead, with large base, quality of the growth is also important, which we want to maintain. So we believe that 22% growth for the current year is very good, and important thing is to grow higher than the market growth rate and keep on improving the market share.
Right, but you don't believe that the kind of growth that you saw, the industry was also seeing of 30-40% in the past couple of years, that will sort of, with the underwriting, with you guys strengthening your underwriting and maintaining a quality of book, that would be a thing of the past, right? The kind of 30-40% growth that we were seeing.
See, when you compare the other companies, I don't want to name any, but you have to look at the size of the business, and it is not fair to compare that. Star Health has more than 65% market share in the SAHI space. So obviously the growth rates cannot match. Given the quality of business and other parameters are more important to us nowadays, we are looking at higher than the industry's growth rate, but focusing more on quality.
Okay, sure. Thank you. That answers my question.
Thank you. The next question is from the line of Ansuman Deep from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. So my question was regarding the slide number 8 that you have given in terms of the adjustments for FY21 and 22. So essentially, 21.3% is the COVID and the non-business of cost adjustment in FY22. So remaining normative combined ratio for FY22 would have been 96.6 odd. So, but in pre-COVID levels, we were doing somewhere around 93. So is this because of the higher growth and the URR requirement under 165? If you could just clarify on that.
Yeah. This, what we are seeing is the full year
right.
COVID and non-COVID loss ratio, which is 65.8%. I think even during the last call, we had mentioned that this 65.8%, though it is non-COVID, there are certain COVID-related protocols that these patients had to follow in terms of the PPE costs, in terms of the COVID test. That is what Dr. Prakash sir answered, that as we move on, as the COVID impact is getting over, the severity of these claims is coming down. For quarter 4, if you see, excluding COVID, the loss ratio is 64%. I think that will be the right parameter to see, pre-COVID and post-COVID loss ratio. And we're confident that, we will be able to achieve that in the coming period as well.
Great. So basically this difference that you're saying also has an element of COVID-related impact on the non-COVID cases as well?
Yes.
Oh, thanks. That will be all. Thank you.
Thank you. The next question is from the line of Devansh Nagotia from SIMPL. Please go ahead.
Yeah, sir. Thanks for the opportunity. So just a reclarification. For ESOP cost, we mentioned 74 crores for FY22. We are guiding 150 crores for FY23. And what would be that number for FY20?
No. See, this is a one-time ESOP tranche given to the chairman and CEO, which was given on 1st December, and it's for a 12-month period. So this is a definite fixed cost for a 12-month period, divided into financial years between FY22 and FY23.
So beyond FY23, currently there are no ESOP which would vest or which can be exercised.
So it's a single grant which will get vested on 30th November after 12 months period.
Okay. And what would be the renewal premium for us? So for, I think, last 4 years, we have disclosed the numbers. But let's say in the period between, let's say, 2011 to 2017, the renewal premium based on volume and based on value, if you can give just a directional number, where would that number be?
So renewal premium, as we have disclosed that in the presentation, on a volume value basis, it is 94% for the 12 months period ended FY22. Volume we have not disclosed.
Okay. And I mean, where would that number lie historically? Let's say, so for in DRHP we disclosed for 3 years, and for this year we have already disclosed. So let's say between period of 2011 to 2017, where would this range of renewals be for us?
It's almost around 95%, 95 to 97% historical data.
Okay. And when we say that our solvency ratio will improve, so assuming a 20% business growth, so are we clocking 20% ROEs in April if that is the direction of profitability, or if you can just share some comments?
See, this combined ratio is something which will be, stable. Profitability is a function of growth and the accounting method that is used. So for Q4, with the highest business, the cost is upfront. So though the combined ratio is in that range, there will be not much profit because the cost of acquisition of that business is upfront. So the profitability and the quarters will not match. It's a function of the growth, the quarter in which you are doing the business, and the combined ratio for that quarter.
Okay. And there was this one-off that we mentioned. So if we look at our adjustments that you mentioned for FY22, the 21.3% includes COVID claims and the one-time settlement of 235 crores in last quarter, correct?
No. So, so the adjustment that we spoke about was related to COVID. So, to that extent, yes. It's all the COVID claims that we say.
Okay. So, regarding this one-off, if you can just highlight, because when you look at the results of other health insurance players, this one-off did not come from them. So, if you can just help us understand how is our business mix different from them, that we had this one-off for our business. If you can just throw some light over there.
It is one-off that we spoke about. It was related to COVID claims, which had come up for reimbursement settlement during Q1, Q2, and we had done certain reduction following ICMR guidelines, state government guidelines. But there were grievances, there were some directions from the regulator that these are your customers, and whatever hospitals have charged, you will have to honor those commitments. We're not sure, it will be definitely there for other players in some quantity. Not sure how much they have disclosed it, but that was the case for us. And it's within the year.
Okay. And for this question might be repetitive, but let's say for UPR adjustment, when we look at the historical numbers using the 50% method against the 1/365 that we are currently using, how would you, how would the combined ratios change in that case? Let's say, in which case it would be higher or in which case it would be lower, in which case reported PAT would be higher or the reported ROEs will be higher. How should one adjust the historical numbers to, look at how the numbers will flow for us in, let's say, next 1 to 3 years? Just a direction on this.
In terms of historical numbers, we had disclosed last 3 years in the DRHP, 19, 20, 21 numbers, and 22 numbers are also on 1 by 65 basis for us.
Mm-hmm.
The second question on 50% profitability, if you take URR to net return premium, it is 56%. So instead of 50% URR, you are actually at 56% URR for the current year. So that's the impact on the profitability that comes.
Okay, so it's just that the absorption of operating expense and commission, which is the difference between these two way of accounting, because claim ratios are any which ways for the premium. If that's the right understanding.
Maybe you can take it offline in detail. It's very specific. We can explain you in detail in terms of how the accounting method is different for 50% as well as 1 by.
Okay. That's it from my side.
Thank you. The next question is from the line of Madhukar Ladda from Elara Capital. Please go ahead.
Hi, good evening, and thank you for taking my questions. First, sir, you mentioned that a couple of products you're looking to increase pricing on. Can you give us some sense on, what extent of price increase could you be looking at, and what percentage of GW are these two products? And second, I wanted to get a sense on the industry. Given COVID claims were very high, and you would have some sense of what competition is likely to do as well. Do you think generally for the industry we should see increases in premiums? So some sort of comments on that would be helpful. Yeah.
The two products that we have recently launched and one in the pipeline, all these are products with very attractive first of its kind features, which the industry has not introduced. For example, we have introduced cover for a newborn baby from day one, and antenatal, and also procedures that can be done in utero. So, we are very, very passionately we are introducing new features like home care, hospice care services, and with rehabilitation, pain management, and that sort. So all these things, are well accepted by the customers, and we are seeing a very good response. And we have also priced it appropriately, so that these products, we wish it should reach around 20% of our sales in this financial year. That should give us considerably good premium, and help us to have more fresh premium, which should subsequently help us in our loss ratio as well.
So I think you had also mentioned that you were looking to raise pricing in two existing products, or did I sort of miss anything and put there?
See, you are right. Existing products we are closely monitoring. One of our products is close to reaching the threshold. Once it crosses the threshold, naturally we will go for price revision. We are monitoring, and it is in the pipeline. One product will be very close to for submission for revision. The other product will be closely watching. As it crosses the threshold, we are going to ask for revision.
And so what would be the percentage, what would those two products be of your GWP? What percentage would those two products be of your GWP?
I was telling you, it should be around 15-20% this year. All the new products that we are going to introduce. And
I'm not talking about the new products. I'm talking about the existing products which are likely to reach the threshold of repricing.
That needs some time for us, because we are going to do the revision based on our actual calculation, and it should undergo IRD approval. And then post-approval, as we launch these products, we will get to know these are all products that are contributing 10 to 15 of the premium so far. So if we are going to increase the premium by another 15-20%, so proportionately we may have some GWP benefit from that.
Right. And finally, any comments on what you see likely to happen in the industry? Loss ratios have been high for the last couple of years. So are we seeing sort of a repricing across the board? What's your sense?
So pricing is now not the only issue. There are multiple multi-pronged approach is what we are trying to do, and there is also a lot of support from the regulator in this direction. So I think we will have to look at acquiring more and more market share. So we have to optimize the price. At the same time, we will have to look at our loss ratios. So we are looking at multi-pronged approach. I don't want to reveal all that in this call, but with the new strategy that we are ideating and we are trying to implement this year, we earnestly look forward to a very positive outcome.
All right, so that's it from my side. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and thank you for taking my questions. Sir, one question is, you have displayed some competitive data, and it seems like in this industry you are much above your competitors. So do you see any sort of a consolidation play happening in this industry as such? Because obviously there are no network effects, but then there is instance of one player of you being very large. How do you see the consolidation playing out? That is one. Second is, now we have gained some scale and we are talking about maybe doubling in the next 3 years. So are there any economies of scale that you see in your cost structure playing out for you in the next 3 years? So while you have guided for a loss ratio of 63 to 65%, and maybe that's completely variable, but on the expense side, do you see any economies of scale playing out for you as you further gain scale from the current size?
So with regard to the consolidation assets, we are in touch with the industry and we don't find any news or we don't see any consolidation happening in the recent future. And on your second question, I'll ask my CFO to answer.
Yeah, so we believe, in terms of expenses, we always ensure that the growth in business is higher than the growth in our expenses, both on the cost of acquisition as well as the operating expenses. And we believe that we'll continue to enjoy operating leverage next year as well as years to come.
Okay, so do you have any sort of a plan in terms of, for example, earlier in FY20 you were at, let's say, around 26-27% expense ratio. So where do you see this number trending in the next 3 years?
So this year our expense ratio is 30.8%. This is largely on account of the change that we had done. Earlier we used to transfer 3% claim processing cost. For the current year, based on our size and scale, we have transferred 1% cost from operating expenses to claims. So 30.8 directionally it will keep on coming down anywhere between 50 to 100 basis point benefit which is continue to
per year.
Yes.
Okay, understood. Thanks and all the best for the coming quarters.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Nilesh Kambli for closing comments. Thank you, and over to you, sir.
So thank you everyone for taking time this evening and joining this investor call and patiently listening to us. We look forward to a profitable and growth-oriented FY23 and the years to come. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Star Health and Allied Insurance Company Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.